Hi, in this video we're going to delve deep into the world of dividend investing, a popular and profitable investment strategy that can provide investors with a stable and consistent income stream. Dividend investing is all about investing in stocks that pay out regular dividends, providing investors with a reliable source of passive income. Whether you're a seasoned investor or just starting out, dividend investing can be a great way to grow your wealth and achieve your financial goals. So in this video we'll be exploring everything that you need to know about dividend investing, from what it is and how it works to the risks and rewards of this popular investment strategy. By the end of this video you'll have a comprehensive understanding of dividend investing and how to make it work for you. If it's your first time here, my name is Alan, and on this channel we talk about all things money, finance and investing. That's also what I cover in my book, The Wealth Wisdom Blueprint, which is available on Amazon. I'll leave a link to that in the description below. So what are dividends? Before we dive into the world of dividend investing, let's start with the basics. What are dividends? In simple terms, dividends are a portion of a company's earnings that are paid out to shareholders. When a company generates profits, it can choose to reinvest those profits back into the business or pay them out to shareholders in the form of dividends. Dividends can take different forms, such as cash dividends, stock dividends or special dividends. Cash dividends are the most common type of dividend, where a company pays cash to its shareholders on a regular basis, usually quarterly. Stock dividends are dividends paid out in the form of additional shares of stock, while special dividends are one-time payments made by a company when it's got excess cash or profits. So why do companies pay dividends? There are several reasons why a company may choose to pay dividends. Firstly, it can attract investors who are looking for a stable and consistent income stream. Secondly, it can signal to the market that a company is financially stable and profitable. And finally, it can provide a way for companies to reward their shareholders for their investment in the business. Why invest in dividend stocks? Now that we understand what dividends are, let's explore why investing in dividend stocks can be a smart move for investors. Firstly, dividend stocks provide investors with a stable and consistent income stream. By investing in stocks that pay regular dividends, investors can create a reliable source of passive income, which can be reinvested or used to fund their living expenses. Secondly, dividend stocks can provide investors with the potential for capital appreciation. While dividend stocks may not have the same growth potential as some high growth stocks, they can still generate returns through both dividend payments and potential increases in stock price. Thirdly, dividend stocks can be less volatile than other types of investment. By investing in companies that pay regular dividends, investors can avoid some of the market volatility that can come with growth stocks or other high risk investments. Fourthly, dividend stocks can provide investors with a way to diversify their portfolios. By investing in a range of dividend paying stocks across different sectors and industries, investors can spread their risk and reduce the impact of any one company or industry on their overall portfolio. Finally, dividend stocks can provide investors with tax advantages. In some countries, such as here in the UK and also in the US, dividend income is taxed at a lower rate than other forms of income, making dividend stocks an attractive option for income-seeking investors. How to choose dividend stocks? Now that we understand the benefits of investing in dividend stocks, let's explore how to choose the right stocks to invest in. When choosing dividend stocks, there are several factors to consider. Firstly, you'll want to look at the dividend yield, which is a percentage of the stock's price that is paid out in dividends. Generally, higher dividend yields are better, but it's important to consider other factors as well. Secondly, you'll want to look at the dividend payout ratio, which is a percentage of earnings that are paid out as dividends. A high payout ratio can be a warning sign that a company is not reinvesting enough profits back into the business, while a low payout ratio may indicate that a company has room to increase its dividend payments in the future. Thirdly, you'll want to look at the financial health of the company. This includes factors such as revenue growth, earnings growth, debt levels and profitability. A financially healthy company is more likely to continue paying dividends and increasing its dividend payments over time. Fourthly, you'll want to consider the industry and sector that the company operates in. Some sectors, such as utilities or consumer staples, are known for their stable and consistent dividend payments, while others, such as technology or healthcare, may have more growth potential but may not pay out dividends or pay lower dividend yields. Finally, you'll want to consider the overall market conditions and economic outlook. In times of economic uncertainty or recession, companies may be more likely to cut their dividend payments or suspend them altogether, so it's important to choose companies that are well positioned to weather economic storms. When researching dividend stocks, it's important to use a range of resources such as financial statements, analyst reports, and industry news. By doing your due diligence and selecting high quality dividend stocks, you can build a diversified and profitable portfolio that provides both income and growth potential. Types of dividend stocks. Now that we know how to choose dividend stocks, let's explore the different types of dividend stocks available to investors. Blue chip dividend stocks. Blue chip dividend stocks are shares in large, well-established companies that have a history of paying regular and consistent dividends. These stocks are typically considered to be low-risk investments as they are generally more stable and less volatile than other types of stock. Growth dividend stocks. Growth dividend stocks are shares in companies that are expected to grow their earnings and dividend payments over time. These stocks can provide investors with the potential for both income and capital appreciation, as they may experience higher than average stock price growth along with regular dividend payments. High yield dividend stocks. High yield dividend stocks are shares in companies that pay out a high percentage of their earnings as dividends, resulting in a higher dividend yield. While these stocks can provide investors with a high income stream, they may also be riskier investments, as companies that pay out a high percentage of their earnings may have less room to reinvest profits back into the business. International dividend stocks. International dividend stocks are shares in companies that operate outside of your home country. These stocks can provide investors with exposure to global markets and the potential for higher dividend yields, but they may also be subject to additional risks, such as currency fluctuations and geopolitical instability. Risks and challenges of dividend investing. While dividend investing can be a great way to generate income and grow your wealth, it's not without its risks and challenges. Firstly, market volatility can impact dividend payments. If a company experiences financial difficulties or market downturns, it may choose to cut or suspend its dividend payments to conserve cash. This can be particularly concerning for investors who rely on dividend income to fund their living expenses. Secondly, inflation can erode the purchasing power of dividend income over time. If the rate of inflation is higher than the rate of the dividend growth, investors may find that their income streams are not keeping pace with the rising living expenses. Thirdly, dividend investing requires a long-term perspective and patience. While dividend stocks can provide stable and consistent income, they may not generate the same short-term returns as high-growth stocks. So it's important for investors to have a long-term outlook and be willing to hold on to their dividend stocks through market fluctuations and economic cycles. Fourthly, there is a risk of dividend cuts or suspensions. Companies may cut or suspend their dividend payments if they experience financial difficulties or market downturns. This can be especially challenging again for income-seeking investors who rely on dividend income to fund their living expenses. Finally, there's the risk of investing in high-yield dividend stocks. While these stocks may offer attractive yields, they may also be riskier investments, as companies that pay out a high percentage of their earnings may have less room to reinvest their profits back into the business, and that could lead to less growth potential and potential dividend cuts or suspensions in future. Despite these risks and challenges, dividend investing can still be a profitable investment strategy for investors who are willing to do their research, diversify their portfolio, and have a long-term outlook. Tips for successful dividend investing. To be successful at dividend investing, it's important to follow some key tips and strategies. Here are some tips to help you make the most of your dividend investments. Firstly, do your research. Before investing in any dividend stock, it's important to do your due diligence and research the company thoroughly. This includes looking at the company's financial statements, industry trends, and economic outlook. By doing your research, you can make informed investment decisions and avoid potential pitfalls. Diversify your portfolio. To reduce risk and increase potential returns, it's important to diversify your dividend portfolio across different sectors and industries. This can help spread your risk and reduce the impact of any one company or industry on your overall portfolio. Reinvest your dividends. Reinvesting your dividends can help accelerate the growth of your portfolio over time. By reinvesting your dividends back into the stock, you can take advantage of compounding interest and potentially generate higher returns in the future. Have a long-term outlook. Dividend investing requires patience and a long-term outlook. While dividend stocks may not generate the same short-term returns as high-growth stocks, they can provide a reliable source of passive income and long-term growth potential. By having a long-term outlook, you can weather market fluctuations and economic cycles. Monitor your investments. Even after you've invested in dividend stocks, it's important to monitor your investments regularly. This includes staying up to date on industry news and trends, tracking your dividend income, and reviewing your portfolio's performance on a regular basis. Conclusion. In conclusion, dividend investing can be a smart and profitable investment strategy for investors of all levels of experience. By investing in high-quality dividend stocks, investors can generate a reliable income stream, achieve long-term growth, and reduce their portfolio volatility. However, it's important for investors to do their due diligence and choose dividend stocks based on factors such as dividend yield, payout ratio, financial health, industry trends, and market conditions. By following these tips and considering the risks and challenges of dividend investing, investors can build a diversified and profitable portfolio that helps them achieve their financial goals. So, thanks for watching. I hope this video has provided you with a comprehensive understanding of dividend investing. If it has, don't forget to give me a like on the video, and you could also subscribe to my channel for more videos on finance and investing and money management. Also, you might want to check out my book, The Wealth Wisdom Blueprint. I'll leave a link to that below. And with that said, I'll see you in the next video.